Imagine this for a moment. You're sitting on the edge of your chair, the charts are bleeding red, Bitcoin is falling, fear is creeping in, and while you're panicking, out there in the deep waters of the market, the whales are playing a game you don't even see. Today we're talking about a report released early this morning at 5 a.m. where Bernstein once again reaffirmed its $150,000 Bitcoin target for 2026. Despite the brutal drop from the $80,000 region down to roughly $60,000 to $70,000. At first, those words feel like a small light in the darkness. But let's slow down and really understand what's happening. Because this market is not random. It's a carefully choreographed interaction between institutional capital flows, ETF dynamics, on-chain movements, and macroeconomic forces, all converging into what feels like a moment of near-final capitulation. The numbers don't lie. Just days ago, Bitcoin fell below $70,000, briefly touching just above $60,000, its lowest level in over a year. Traders watched positions get liquidated, whales shifted coins across wallets, and major ETF products like IBIT and GBTC saw massive multimillion-dollar outflows. And yet, Bernstein stands firm on its $150,000 bullish thesis. Not as wishful thinking, but as a statement of structural conviction, even in the face of brutal momentum. Their argument is clear. This is the weakest bear case in Bitcoin's history, not a failure of fundamentals, but a crisis of confidence. Why does that matter? Because claims like this don't come out of thin air. Bernstein sees institutional adoption and ETF infrastructure as the core driver of Bitcoin's long-term trajectory, and the on-chain evidence supports it. Spot Bitcoin ETFs now hold over $165 billion in Bitcoin-related assets under management. That's a massive pool of capital, and it doesn't disappear overnight. While benchmark indices slide and retail traders panic, large addresses are doing something very different. They're accumulating slowly, methodically, buying coins when the rest of the market believes it's time to sell. The whales know exactly what they're doing, and their behavior mirrors earlier phases. 2017, when institutional interest quietly laid the groundwork, or 2020, right after the halving, when Bitcoin began a new rally despite global chaos. Historically, Bitcoin has used its deepest drawdowns to prepare for its next all-time highs. In 2018, the final capitulation sell-off led to months of accumulation, which then exploded into the massive 2019 to 2020 run. After the 2020 halving, even in the middle of a global pandemic, Bitcoin surged dramatically. And now we're back at a critical point, where history may not repeat exactly, but it's clearly rhyming. While you're panicking, you may be underestimating one of the most important forces in this market, the institutional supply and demand barrier. Bitcoin is no longer just a hobby asset for tech enthusiasts. Corporations are holding Bitcoin on their balance sheets. ETFs are pulling capital from traditional portfolios. And macro trends like inflation and instability in other markets are pushing investors toward Bitcoin as a hedge, similar to gold, but with a fixed supply. We're seeing central banks increase their gold reserves, while Bitcoin's relative share compared to gold has declined, a paradoxical signal of disrupted confidence and capital reallocation. And miners? They're still holding coins or selling strategically in small increments instead of panic dumping. That reserve behavior continues to support long-term bullish narratives. But there are real risks, and Bernstein doesn't ignore them. If Bitcoin breaks below the critical $60,000 support level, the narrative foundation will be severely shaken. Cascading liquidations could follow, short positions could unwind violently, and the market's technical structure could break down, similar to the fall of 2025. When Bitcoin lost its 2021 highs and derivatives indicators warned of further downside. This is the thrill of this market. Fear and greed locked in a constant dance, swinging between panic liquidations and muted institutional confidence. And this is where the narrative shift comes in. Bernstein describes the current structure as an extended bull cycle, breaking the traditional four-year pattern, driven not by retail leverage, but by ETF flows and structural capital. Picture the market like a beach ball being held underwater by institutional hands. Feels heavy. It wants to sink. But the moment that pressure is released, it rockets upward with force. That's exactly what could happen if Bitcoin forms a base, supported by renewed ETF inflows, slowing sell pressure, and potentially supportive US policy if the correction deepens. So what do the on-chain signals say? Short-term whale activity does show distribution patterns, selling near resistance, accumulating near support zones. At the same time, open interest and options market sentiment point to rising volatility. A large number of puts and calls are expiring, creating latent pressure that often precedes explosive moves. Here's the emotional twist. While many are selling out of fear, a quietly positive dynamic is forming, not through hype or fictional pump stories, but through real structural changes in the market. Institutions aren't here to buy every dip and flip it tomorrow. They're building long-term positions and hedge strategies, treating Bitcoin as a core component of diversified portfolios. And that's exactly what Bernstein means when it says this market is now more macro-driven and allocation-driven than ever before. Let me paint one last picture. You're standing on the shore, watching a stormy ocean. The waves are violent, crashing against your boat. That's the current market. But deep below the surface, a massive current is carrying large ships and heavy cargo toward calmer waters. That's institutional capital, patient, strategic, accumulating, and not waiting for the next pump and dump. So what does this mean for you, for every trader watching right now? It means this moment matters, not just emotionally, but historically. Comparisons to 2018 and 2020 show that the brightest moves often follow the darkest periods. The risk is real. If Bitcoin breaks below $60,000, the pain will be intense. But if it holds, builds a base, and regains momentum, the next chapter could become a defining moment in Bitcoin's history. Now I want to hear from you. Do you think Bitcoin holds this level? Drop your thoughts in the comments. Are you watching on-chain data that confirms or contradicts this narrative? Let's debate it, because these discussions bring clarity while most of the market is still in the dark. Subscribe if you want deep, data-driven analysis. This channel isn't about empty hope. It's about understanding the forces behind the numbers. And if this video helped you, hit the like button. Market sentiment is a currency of its own. By the end of this video, there's one thing you should understand clearly. This market is not random. It's a game of supply, demand, trust, psychology, and capital flows, visible only if you know where to look. And that's what makes Bitcoin so fascinating. Not the short-term volatility, but the deeper structure that's forming right now.